Hello, everyone. This is Colby Valenta with Valenta Capital Management. Welcome to today's webinar. Today we'll be discussing 2018 tax strategies. First and foremost, just want to let everybody know neither myself nor anyone at Valenta Capital Management are tax experts. If you have tax-specific, tax-related questions, I would go to your CPA, chat with them because they'll know your situation far more intimately than anybody here will. So that's the aside. Also want to let you know there's going to be a lot of information in this webinar today. So questions, concerns, that kind of thing. Obviously, talk to your CPA, give us a call. We'll chat with you as well. All right, let's get this thing going. So first things first, please take a look at all of the disclosures on the screen here. We need to keep the regulators and attorneys happy. We must also point out that there are no perfect investments. Every option has benefits and risks. There are no particular investments that are right for everybody. You might hear pitches for products or investments in other seminars, but you're not going to hear any of that today. Today is just about some information, and we don't believe in the perfect investment. This workshop is simply here to provide you some information that you might need. Okay. So before we get into today's talk, let's go back in history a little bit. The first income tax was proposed back in 1814 to help fund the War of 1812. It was based on the British Tax Act of 1798, but it was never enacted. The Treaty of Ghent ended hostilities in 1815. So fast forward a little bit. President Lincoln signed the Tax Act of 1862, which set 3% rates on income above $600 and 5% rates on income above $10,000. Following the end of the Civil War, the public really began to lose interest in income taxes. I think they still have lost some interest in income taxes. And the Tax Act of 1864 was modified to a flat 5%. The exemption was raised up to $1,000, and several attempts were made to make the act permanent, but they all failed following complaints from business leaders. Tariff restrictions were enacted in the 1870s following the repeal of the Tax Act, and those tariff restrictions provided the bulk of the nation's revenue until 1913. The 16th Amendment was passed in 1913, giving Congress authority to tax incomes of all American citizens. Federal income taxes never exceeded 1.4% of the gross national product until 1938, and by 1944, those numbers rose to 9.2%. The White House Office of Management and Budget estimates that individual taxes will total about 9.2% of gross domestic product this year and rise to 9.5% by 2022. The GDP is more than $18.6 trillion, so income taxes generate nearly $1.8 trillion annually. So, looking at this chart, we can see that the marginal tax rate on top earners has varied significantly over time. In 1915, it was just 7%. However, after World War II, the highest marginal tax rate jumped to 94%. 94%. It dropped slightly in the years after the war, but rose sharply again in the 1950s. Despite being at 50% for most of the 80s, it dropped and stayed at 28% for 3 years in the late 1980s, before rebounding back up to 39.6% in 1993. It dropped off a little in the early 2000s. The American Taxpayer Relief Act of 2012, signed into law in January of 2013, preserved the tax rates of lower income and middle income Americans, but it raised taxes on the wealthiest taxpayers back to that 39.6% rate. This year's tax rate for the highest earners is 37%, which lasts until 2026. The rate reverts back to 39.6 at that time unless Congress reinstates the lower levels. Obviously, we'll keep you informed of developments and how they may affect you moving forward. Income taxes cover around 48% or nearly $1.66 trillion of all federal revenue. High earners contribute comparatively more to the federal budget than other groups. So let's take a look at these numbers. Americans who earned more than $200,000 per year, 4.5% of all returns, paid nearly 60% of all federal income taxes. Taxpayers making below 30% or $30,000 per year, 44% of returns, paid nearly 1.4% of all income taxes. Earners making more than $2 million but under $5 million paid nearly 21% of all income taxes. So we're not going to discuss the politics of taxation, but we will explore how to prepare for the new tax environment. So today we're going to cover 8 specific issues, and we've got a lot to cover, so we'll keep the presentation moving after I run through all 8. So we're going to look at tax changes for 2018, Roth Conversion Opportunities in 2018, how healthcare laws might affect your taxes, distribution, ways to help keep what is yours, tax smart asset allocation, Gift-Tax Exclusions, pros and cons, Treasury Securities and tax-exempt municipals, to give or not to give, giving appreciated assets to charity. So we'll start by discussing some of the changes in the tax laws for 2018. The Tax Cuts and Jobs Act eliminated several deductions and exemptions and created new brackets starting this tax year. Here are the inflation-adjusted amounts for 2018 and the status of a couple of deductions. So the highest tax bracket starts an adjusted gross income over $500,000, $600,000 for married couples filing jointly. The P's limitation on itemized deductions will be eliminated. Personal exemptions were eliminated for the 2018 year, but are expected to be reestablished in 2026. The alternative minimum tax, AMT, exemption amount increases to $70,300, $109,400 for married couples filing jointly. So just to clarify, these are the applicable numbers for the 2018 tax year, which will not affect anything, in years past, obviously. We'll also see Social Security payroll tax limits increase for higher earners. So maximum taxable earnings increase for 2017 was $127,200, but in 2018 it's going to be $128,400. This adjustment took effect on December 29th of 2017, and the increase is a result of the estimated real wage growth rate. The increase will both affect employers, as they have to pay their share of payroll taxes over the previous earnings limit, and employees, who will pay more in taxes. No one likes paying taxes, but they will be here to stay for better or for worse. We always like to emphasize that taxes are just one component of your overall financial plan. You should make any changes in your investment strategy with a long-term view of financial goals and the support of a tax advisor. However, as we go through this material, we will try to share some simple tax savings strategies with you. For all purposes, practical purposes, we can assume income taxes are here to stay. For most taxpayers, these new changes increase the importance of tax sensitivity in their financial planning by taking advantage of tax-deferred accounts, managing investment sales, and properly structuring retirement withdrawals. To minimize the taxes you owe, consider maximizing your contributions to tax-advantaged accounts such as 401ks, IRAs, and HSAs. If you're still working and your employers offer a non-qualified deferred compensation plan, a popular option for executives, you might want to consider participating as a way for you to defer part of your compensation and the income taxes on it. Despite changes in the tax laws, capital gains don't change. Taxpayers in the highest bracket will be taxed at a rate of 20%, while those in the lower bracket pay 15%, and those in the lowest brackets below 24% will pay nothing. So when we look at the high tax rates for the highest brackets, 24 to 35% income tax bracket, that equals about 37% income tax bracket for, you're looking at these long-term capital gains. So as a reminder, you must hold a security for at least 1 year for special capital gains treatments. Not all dividends qualify, and dividends must meet certain IRS criteria, which we won't get into today. Non-qualified dividends are taxed at the ordinary income tax rates. You may be able to reduce dividends and capital gains taxes. Of course, you need to consult with a financial professional to see how to do that with your unique financial needs. One way to reduce investment-related taxes is to move taxable assets to a tax-deferred account such as a 401k, IRA, annuity, or health savings account. We support this approach for a few different reasons. Number one, it allows investments in the account to grow tax-free or tax-deferred. And number two, contributions to these accounts can help reduce your overall tax burden each year. You may be able to reduce your tax liabilities by revisiting your asset allocation strategy and shifting your investments to assets that generate tax-exempt income, such as municipal bonds. Tax-exempt income is not part of the calculation when figuring the surtax on unearned income. With the current rates unchanged, you might want to run these numbers on that strategy again just to make sure they fit your needs. Remember, however, that municipal bonds are subject to the alternative minimum tax. That being said, you should base a prudent investment strategy on your investment goals, appetite for risk, and timeline. As important as taxes are, they shouldn't completely shape your investment goals. Retirees or those who are no longer eligible to contribute to tax-deferred accounts might need to develop alternative and additional strategies. Since strategies depend so much on individual situations, we recommend consulting directly with an asset and financial professional. How can you reduce the impact of these new surtaxes? Basically, it all comes down to trying to reduce your gross income with contributions to qualified plans such as 401ks, SEPs, IRAs, and HSAs. Salary deferrals to 401ks and similar plans are excluded from gross income, and contributions to retirement accounts are above the line deductions, which reduce adjusted gross income and your potential exposure to these taxes. Business owners and high-income professionals might also want to consider switching to a defined benefit or other alternative plans. And in some cases, these allow large contributions, which of course you can deduct. So things like cash balance plans, etc., and those are all things that we can chat about with you. Of course, possibly building up retirement savings at an accelerated rate isn't a bad benefit of its own. Let's briefly discuss retirement plans. Contribution limits went up slightly for this year for retirement plans, but remain the same for catch-up contributions for employees 50 years or older. So 401k limit change. Taxpayers may contribute now up to $18,500 to their 401ks, 403bs, most 457 plans, and federal thrift savings plans in 2018. The catch-up contribution limit for employees 50 or older is $6,000, the same as it was last year. IRA limits remain unchanged, so the limits on IRA contributions will continue to be $5,500 in 2018, and individuals over the age of 50 can make an additional catch-up contribution for an extra $1,000. Now we see slight changes to IRA deduction limits and Roth IRA cutoffs. So the tax deduction for traditional IRA contribution phase-out range depends on your filing status and workplace retirement plan coverage. If you're single with a workplace retirement plan, that phase-out range is $63,000 to $73,000. If you're married filing jointly and the IRA contributor has a workplace retirement plan, that phase-out is $101,000 to $121,000. So married filing jointly and the IRA contributor does not have a plan like a 401k, that phase-out range is $189,000 to $199,000. So let's look at Roth IRA income cutoff. So the AGI phase-out for both Roth IRAs rises in 2018. So single and head of household, that phase-out range is $120,000 to $135,000, and if you're married filing jointly, it's $189,000 to $199,000. The IRA rollover limit rule remains in effect for 2018. The rule is established in 2015 and allows taxpayers one IRA rollover from one account to another in a 12-month period. Doesn't matter how many IRAs you have. The rule does not apply to trustee transfers where the account holders don't directly receive the money. It also doesn't apply to Roth conversions or rollovers between a 401k and an IRA, for example. The 60-day limit still applies to all rollovers, so when you withdraw any money from an IRA, you have to get that money back into an IRA within that 60-day time limit, or you will risk paying taxes and penalties. So President Trump's tax law included lower individual and corporate tax rates, and analysts really predict budget proposals may produce surpluses by 2027. So revenue. The budget is expected to generate $3.654 trillion in revenue. Income taxes are expected to generate 50%, Social Security, Medicare, and other payroll taxes 33%, corporate taxes 10%, excise taxes and tariff 4%, Federal Reserve holding 2%, and estate and other miscellaneous taxes 1%. So now we'll look at spending. Most of the federal government's spending will pay for mandated expenses. Interest on national debt is about $315 billion, and it's the fastest growing budget expense. Well, when you have trillions worth of dollars of debt, That makes perfect sense. Discretionary spending covers 38% or 1.244 trillion of the budget. More than half of that goes to the military and veterans affairs. And then we'll look at budget cuts. President Trump's tax law cuts more than $4.2 trillion from the budget in the next 10 years. The budget may cut more than $3.5 trillion over that time. According to projections, Trump's budget could produce a $16 billion surplus by 2027. The 2012 Tax Act made the higher tax-free estate, gift, and generation skipping transfer limits permanent and indexed them to inflation. The exclusion amounts for individuals who die in 2018 increased to $10 million. So if you want to give money to your children as a gift during your lifetime, leave money to an estate, or establish a generation skipping transfer for grandchildren, as any money under $10 million won't be taxed by the IRS. The IRS will tax any amount over that at a rate of 40%. As lifetime gifts, the estate, gifts, and generation skipping transfer limits are expressed as a lifetime total amount. So it doesn't matter if you give your money as a gift or leave it to your estate, the total amounts will remain the same. You are still able to give up to $15,000 each year tax-free as a gift. We'll discuss this more a little bit later. But on a final note, we are not accountants, but as financial professionals, we feel it's important to keep with current political and legislative developments that may impact assets and investments our clients have entrusted to our care. So let's move on to talk about Roth conversions. The American Taxpayer Relief Act introduced some new opportunities for Roth conversions. While the Roth conversion is not right for everybody, it does provide advantages for some investors, in particular for those who have money in 401ks. You might be able to direct and convert those assets to a Roth 401k. Let's consider a few factors. In a Roth conversion, you withdraw money from a traditional IRA, pay all the federal and state taxes due, and move that money into a Roth IRA. All future growth and withdrawals are then taken tax-free. The potential advantages to a conversion are as follows. Qualified Roth distributions are tax-free and are not subject to the Medicare tax and do not add to your gross income. A taxpayer can no longer undo a Roth conversion. There are no required minimum distribution when a taxpayer reaches age 70 and a half, and you can leave a Roth to your heirs, which will generate tax-free income for them. I want to mention that a year in which your investment sustain a loss can be a good time to do a Roth conversion, since you'll be paying taxes on the converted amount. If that's something you want to discuss, we can chat about that. Of course, there are potential disadvantages to converting a traditional IRA to a Roth IRA. Some of the drawbacks of a Roth IRA conversion are as follows. There are fewer tax growth benefits if your Roth IRA earnings are quite lower over the time the funds you hold in it. Conversion might not be advantageous if tax rates applied to the IRA withdrawals during retirement are lower than the tax rate paid on the conversion. Conversion might not be advantageous if converting your Roth IRA significantly increases your tax burden. You reduce the benefits of a Roth IRA conversion significantly if you use the IRA funds to pay for a conversion tax. So you'll want to make sure that a tax conversion makes sense for your unique financial situation by consulting with a financial professional. I also want to take a moment to talk about the so-called backdoor Roth contribution, in which you make a contribution to a traditional IRA and convert it to a Roth. While it's a handy way to get money into a Roth if you don't meet the income qualifications for direct contributions, it isn't as simple as it sounds, and there are many critical details to consider. Also, President Obama's 2017 budget eliminates this ability. However, President Trump's budget reverses it. If you don't qualify for Roth contributions and would like to explore this option, we can talk about this as well. So let's talk about how healthcare laws might affect your taxes this year. Although Tax Cuts and Jobs Act removed the health insurance requirements of the Affordable Health Care Act, penalties are still in place for 2018, and those same penalties will be lifted in 2019. The Affordable Health Care Act required everybody to get health insurance or pay a penalty. The penalty for not having health insurance is the same as it was in 2017. 2.5% of your household income, or $695 per adult, whichever is greater. The maximum family penalty for 2018 is $2,085. So the Affordable CARE Act also introduced new tax forms, and some taxpayers will need to complete those forms in 2018. So, what's the future of this lovely Affordable Health Care Act? You'll get a 1095 form associated with the type of and source of health insurance coverage that you had for the year. Depending on the type of form you receive, it will show the type of coverage you had and any tax credits you received, any dependents on your policy, and the coverage period. However, if you're not sure what form you're due to receive or have any questions about insurance and your taxes, consult a qualified tax expert. The recently passed Tax Cuts and Jobs Act removes penalties for not having health insurance. However, as we mentioned, the penalties will remain in effect for 2018, but they'll go away in 2019. The future of the Affordable Care Act really remains to be seen. In 2013, two major healthcare taxes came out of the books that specifically targeted high-income taxpayers. The first was a supplement to Medicare wages, and the second was a Medicare investment tax, which affected investment income. Let's get started with the Medicare Wage Tax. As of 2013, high-wage individuals have to pay an additional 0.9% on wages above a certain threshold for a hospital insurance tax. Well, who's subject to this additional tax? If you're married and filing jointly, you are subject to a 2.35% hospital insurance tax on your combined wages that exceed $250,000 as compared to the 1.45% tax you pay on wages below that threshold. If you're married but file a separate return, the additional tax will apply to wages that exceed $125,000. For everyone else, the threshold is $200,000 worth of wages. So in 2017, a single individual with wages of $240,000 would owe an HI tax at a rate of about 1.45% on the first $200,000 of wages and an additional 2.35% on the remaining $40,000 of wages for that year. Fortunately, some retirees get a break. Distribution from retirement accounts and Social Security benefits are not assessed with that tax. The second Medicare tax affects investment income, also known as unearned income. This additional 3.8% applied to investment income for any investor earning above $200,000 for individual filers and more than $250,000 for couples filing jointly. This is an additional tax, and it really is applied to dividends, capital gains, rents, and royalties, the taxable portion of any non-qualified annuity income, and any income from a business considered a passive activity. However, you exclude tax-exempt interest on bonds, veterans benefits, and life insurance proceeds from gross income. These are not considered investment income for additional tax purposes. Qualified retirement plan and IRA distributions are also not considered investment income. You will calculate the tax by multiplying 3.8% and the lower of either your net investment income for the year or your income above the threshold level. Some trusts are also subject to this tax. The particulars are complex, so it's wise again to consult a tax professional. These threshold amounts have not been indexed in inflation, meaning they haven't really changed since 2013. Therefore, they potentially affect taxpayers more every single year. Prior to the Affordable Health Care Act, you could deduct medical, dental, and other health care expenses that exceeded 7.5% of your adjusted gross income. That number goes up to 10% in 2019. Most medical expenses include those associated with diagnosing, treating, or preventing diseases, qualifies such as prescription drugs, some insurance premiums, medical equipment, and travel costs for appointments. Remember, you can't deduct expenses that were later reimbursed. On to our next point, distributions and ways to help keep what is yours. Another way to keep more of your money, that's, by the way, very hard earned, is to think about how taxes may affect your income strategy. Here are some ways to potentially avoid tax pitfalls when taking these distributions. Inventory all potential sources of retirement income. That will include pensions, 401ks, 457, 403b accounts, IRAs, Social Security payments, annuities, and personal savings. You'll really want to determine the tax treatment of each item and what changes to your income source may mean after your taxation. Determine whether you should consider adjusting your asset location to move assets into tax-deferred accounts or maximizing contributions to reduce your reportable income. Determine which assets are subject to required minimum distributions, and these distributions rules apply to many retirement plans and generally start on April 1st following the year you turn 70 and a half. You'll really want to create a plan to minimize taxes now, especially if you fall into the highest tax bracket, and to determine when you will pass assets to your heirs. Again, we understand that some of this information might seem confusing or overwhelming, and that's why you really need to discuss your overall situation with both a professional financial representative as well as a tax professional. On to our next point, asset allocation. Asset allocation, not to be confused, asset location, not to be confused with asset allocation, attempts to minimize your tax liabilities by taking advantage of the different tax treatments that some investments undergo. Using this approach, investors strive to maximize their after-tax returns by strategically determining which securities to hold in your tax-deferred accounts and what to hold in your taxable accounts. So, how do you know what's best for your assets? Well, the best strategy really depends on several factors, including your age, finances, relevant tax laws, and underlying securities. If you'd like to explore asset allocation to see if it's the right strategy for you, we strongly advise you consult your financial professional and, again, a tax professional to discuss your opportunities. Now, let's talk about getting the most out of gift-tax exclusions, which are powerful estate planning tools. So the gift tax exclusion allows you to give $15,000 in 2018 to anyone without having to use your lifetime gift exemption amount. As long as you limit the gift each year to that exclusion amount, the IRS does not require that the giver file a tax return. No gift taxes will be due. The $15,000 exemption is indexed for inflation and is granted separately to each recipient. Here's an example. So let's suppose a couple has 3 children. The 2 parents could give a total of $90,000 to their children. That's $15,000 to each child by both parents. Again, this does not apply to the lifetime exemption. Recipients of the gift do not have to pay taxes. Donors are responsible for the taxes. The simplest way to use the annual exclusion is to give cash or other assets each year to as many people as you want. Even if you give more, you still won't have to pay federal taxes, at least until you reach that lifetime gift exclusion of $10 million in 2018. It was $5.49 million in 2017. You may give more individuals by making direct payments to certain qualified medical, dental, and tuition expenses, which don't count against your annual or lifetime gift exclusion. Okay, so we're nearing the end of our points. We just have a few left. Let's move on to highlight the Treasury Securities and tax-exempt municipals. We could talk a lot about Treasury Securities, but for the sake of time, we'll discuss just a few points. So for high-income taxpayers who live in a high-income tax state, investing in Treasury bills, bonds, and notes, they have the potential for tax savings. The interest on Treasuries is exempt from state and local taxes. Investing in Treasury bills that mature in the next year leads to a deferral on the tax until next year. Remember that Treasuries may be subject to capital gains. If you sell a Treasury at a gain, you would be subject and have a taxable gain. Since Treasuries are the least volatile and most reliable investments available, they typically offer lower interest rates compared to other taxable fixed income investments. Many investors choose Treasuries for their security and stability, and as a low-risk investment, Treasury securities provide balanced and diversified portfolios. The government guarantees timely payment of principal and interest on Treasury bonds and bills. If held to maturity, they offer a fixed rate of return and a fixed principal value. However, the value of a bond is not guaranteed and it will fluctuate. Municipal bonds may be helpful for preserving your assets and creating tax-free income. When you buy muni bonds, you're essentially lending money to school or to local, county, state, or other government agencies. Government entities promise to pay you a return based on interest and return your principal at a certain date. Governments use bond money for constructions of things like schools, roads, hospitals, and other types of public projects. Muni bonds generate income that, for most investors, is exempt from federal and in many states, tax and local income taxes. Not all muni bonds offer income exemption from federal and state taxes, but again, we can chat with you individually. Defaults on muni bonds are rare. Only 99 Moody's rated municipal insurers defaulted on bonds issued between 1970 and 2015. Two financial sectors accounted for 68.7% of the default, and those were housing at 45.5% and hospital and health services at 23.2%. In the same period, there were 99 defaults of the thousands issued. That's an annual 0.09% of all rated municipal bonds. Analysts say trends show bond defaults are happening less frequently, primarily because more refinancing opportunities are available. Low interest rates are also bolstering the trend. Keep in mind that there are bad investments, and we strongly advise that you analyze the financial health of both public and private entities before investing. That's why you should really, again, consult with a financial professional who understands your situation and your goals. Buying municipal bonds is a part of a conservative investment strategy, but it is not risk-free. Muni bonds are subject to availability, price, and market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, a scenario you might want to pay close attention to right now and moving forward into the future. Interest income might be subject to the alternative minimum tax. Municipal bonds are federally tax-free, but state and local taxes might apply. If sold prior to maturity, capital gains tax could also apply. Again, please consult an investment professional and a tax professional prior to investing in this type of strategy. Our final point is giving to charity. Why did we leave this for last? Well, we wanted to focus on helping ensure your financial house is in order before you examine how you can support charities. Ultimately, this is one of our primary goals at Valenta Capital, and it's to help our clients enjoy what they have worked to accumulate. We would be remiss if we didn't mention that, thanks to certain tax consideration, giving in the proper way can provide you, the taxpayer, with some worthwhile tax deductions. If you're planning to give to charity, one tax-efficient way is by donating appreciated stocks, bonds, or mutual funds to a charity rather than selling and giving to cash. Donating the asset instead of the cash eliminates the requirement to pay capital gains tax on the sales, which can generate considerable savings. The amount you save depends on your tax bracket, and that tax really would be due on the sale. You can also get a tax deduction for the fair market value of your property if your gift is to a qualified charity. You can only make charitable contributions from IRAs, not 401ks or similar accounts. At the end of 2015, Congress made permanent the IRA contributor giving tax break. This enabled taxpayers who were at least 70 and a half old to make donations directly from their IRAs if they don't need to use something like their RMDs. Now, taxpayers who are subject to required minimum distributions, they can really use all or part of their RMDs to make these qualified charitable contributions directly to get some special tax treatment. All right. So I hope you feel benefited from today's presentation and gained some insight and some valuable perspectives on your tax circumstances. I understand that all the various tax insights may seem confusing. How all of these details fit in your financial vision can even get more complicated. Just think, we haven't even discussed inflation, longevity, risk tolerance, how emotions affect investing, and a whole bunch of other related factors. That's really where Valenta Capital comes in. As a registered investment professional, our job really is to help cut through all your clutter and make sense of your complexities. That's why we really stress things like implementing a financial plan to make sure you have the ability to pick appropriate investments and build a portfolio that is unique to you and reflects your, again, unique needs. At Valenta Capital, again, our goal is to really help analyze your current situation, help select suitable investments, really set some realistic expectations for performance, and monitor your portfolio and recommend some changes over time. So we really and sincerely hope that you've enjoyed our presentation today. Again, if you have any questions or concerns that might have sprouted up as a result of this, please give us a call. You can reach us at 303-951-5975, or you can visit our website, www.valentacapital.com, and drop us a line there. Thank you very much for logging on. It's been a pleasure. Have a great day.